What's up, everyone, and welcome back to the Web3 Daily, where we break down the latest market moves. Honestly, the market's been a bit of a snooze fest the last couple of days. Bitcoin is just chopping back and forth around that $110,000 mark. It feels like both the bulls and the bears are in a standoff, each waiting for the other to make the first move. But if you're just watching the price, you're missing the real story happening beneath the surface. I've noticed a fascinating trend, a quiet rotation of capital. You see, while the spot Bitcoin ETFs have seen net outflows recently, capital has been flowing into projects within the Ethereum and Solana ecosystems, which are holding up surprisingly well. What does this tell us? It means smart money isn't just betting on the macro anymore. They're actively hunting for assets with solid fundamentals and real-world value. On top of that, on-chain data shows that the cost basis for long-term holders, the diamond hands of the market, is forming a powerful support level right where we are. These aren't your typical short-term traders. Every buy they make is a high-conviction bet on the future. So, while things might seem calm on the surface, this underlying accumulation of strengths could be the setup for the next major leg up. Now, let's dive into the main topic I want to discuss today. Honestly, this might be the single most important narrative for all of 2025, the tokenization of real-world assets, or RWA. Many people have heard the term, but they haven't truly grasped what it signifies. Simply put, it's about bringing valuable things from the real world, like US treasuries, corporate bonds, even real estate, onto the blockchain. You might think this is old news, but just look at the data. The total value locked in the RWA market has skyrocketed from around $8.6 billion to over $25 billion in the past year alone. And more importantly, look at who's getting involved. BlackRock, Franklin Templeton, the true titans of the traditional finance world. Once these trillion-dollar players start sprinting into the space, you know this is no longer just a concept, it's a full-blown financial revolution. The genius of this revolution is that it solves the core problems of two different worlds simultaneously. For us in crypto, it brings a flood of real, stable, and predictable yield assets to serve as collateral. This allows DeFi protocols to finally have a solid foundation, moving beyond the self-referential game of crypto on crypto. For traditional finance, it solves a centuries-old problem, liquidity. Think about it. Selling a commercial building or a block of private equity used to be an incredibly complex process that could take months. But once you tokenize it, you can fractionalize it and trade it 24/7 on a global market. Just like an ERC20 token, the value this unlocks is measured in the trillions. So, the way I see it, the true role of RWA is that of a translator. It translates the value that traditional finance understands and trusts into code that the blockchain world can read and execute. This is the bridge that will finally allow trillions of institutional dollars to flow into our ecosystem. The winners of the future won't just be the clever DeFi protocols. They will be the teams who master compliance and build this bridge to be the strongest. Okay, moving on from the big picture narrative, let's look at a perfect example of that narrative becoming a reality. Just yesterday, Ondo Finance, a leading project in the RWA space, dropped a bombshell. They launched tokenized versions of major US stocks and ETFs on Ethereum. What does that mean? It means you can now directly own tokenized versions of shares in companies like Apple, Microsoft, and NVIDIA, or even SP500 ETF, right on the blockchain. My first reaction when I saw this news was, this is what RWA is supposed to be. We're not talking about tokenizing some obscure asset anymore. This is bringing the most liquid and widely recognized core assets in the world on-chain. And how did they do it? They partnered with Alpaca, a FINRA-regulated broker-dealer, to ensure all the underlying assets are genuinely and completely held. But the most critical step is that they turned all these stocks into standard ERC20 tokens. This completely unlocks the possibilities. These tokenized stocks are no longer just certificates of value. They've become money Legos that can be used, combined, and put to work in the world of DeFi. You could use them as collateral for a loan on Aave or provide liquidity with them in a curve pool. This is like injecting DeFi with a direct stream of the highest quality capital from the traditional stock market. This isn't just about making it easier for non-US investors to buy American stocks. More importantly, It's the first time a real, meaningful bridge has been built between the world's largest equity market and the most innovative decentralized finance ecosystem. If Ondo is proactively building bridges within a compliant framework, then this next piece of news is about regulators opening a door for innovators. The well-known prediction market platform, Polymarket, after nearly 3 years, has finally gotten the green light from the US Commodity Futures Trading Commission, or CFTC, to resume operations in the US market. The most interesting part of this is that it's a comeback story. You might remember that back in 2022, Polymarket was hit with a hefty fine by the CFTC and forced to exit the US market for offering what were considered unregistered binary options. At the time, many thought the prediction market sector was dead on arrival in the States, but now the tide has completely turned. The CFTC has issued a no-action letter to Polymarket, which essentially says, for the specific event contracts you're offering now, we won't take enforcement action against you. You're clear to operate. The signal this sends is, in my opinion, more important than the event itself. First, it suggests that U.S. regulators might be becoming more pragmatic, starting to distinguish between genuine financial risks that need to be shut down and Web3 innovations that are worth exploring. Second, this is a massive legitimacy win for the entire prediction market sector. The US is the most important source of events for these platforms, from presidential elections to Fed interest rate decisions. With US users back in the game, the liquidity and the potential of the entire market will be magnified by orders of magnitude. Polymarket's return could very well be the starting gun for explosive growth in this sector. Now, let's shift our focus from the US to the East, where Hong Kong is playing a strategic long game. Recently, the Hong Kong Monetary Authority, or HKMA, officially revealed the latest progress on its regulatory framework for stablecoin issuers and plans to launch a formal licensing application process very soon. The details of this framework are pretty much what you'd expect. There are 3 core requirements. First, issuers must maintain 100% reserves in high-quality liquid assets. Second, these reserve assets must be strictly segregated from the company's own funds. And third, they must undergo regular independent audits and disclose the reports to the public. Now, these rules themselves aren't surprising. But what makes Hong Kong's approach so smart is that they've skipped the vague regulatory sandbox phase and gone straight to providing a crystal clear rulebook. For institutions holding massive amounts of capital and looking for a compliant way to enter the market, this kind of regulatory certainty is incredibly appealing. We often talk about the US approach as regulation by enforcement, where you never really know where the red lines are until someone gets sued. Hong Kong is choosing a different path. They're laying out the rules of the game up front. As long as you play by their rules, they'll give you a license and a safe harbor to do business. This reveals Hong Kong's huge ambition to become a global Web3 hub. They understand that stablecoins are the bank accounts and the base settlement layer of the entire crypto world. By anchoring this foundational infrastructure with a clear set of regulations, they are building the most solid and trustworthy foundation for the entire digital asset ecosystem to grow upon. It's a brilliant strategic move, in my opinion. Alright, we've covered products, regulations, and regional strategies, but all of this is happening within a much larger macro context. And what is that context? Wall Street legend and founder of Bridgewater Associates, Ray Dalio, recently gave a very clear and frankly somewhat alarming answer. Dalio's core argument is that the United States is heading into an unavoidable debt crisis. He's done the math. The sheer volume of government bonds the US needs to issue now far exceeds the capacity of traditional buyers like foreign central banks. So how do you fill that massive gap? There's only one way. The Federal Reserve has to print money to buy the debt, a process known as debt monetization. The direct consequence of this action is the long-term devaluation of the US dollar. And when the world's dominant currency is constantly being diluted, what does smart capital do? It seeks out assets with a finite supply, assets that can't be printed out of thin air to use as a store of value. This is what we call hard assets. And in Dalio's analysis, he explicitly names the 2 most important safe havens for this scenario. One is gold and the other is Bitcoin. So this is where it gets really interesting. The long-term value of Bitcoin might not depend on the next killer app or which layer 2 has better performance. Its most solid underlying bull case comes from the inherent flaws of the traditional fiat monetary system. When a top-tier investor like Dalio, who manages hundreds of billions and thinks in decades-long cycles, starts publicly putting Bitcoin in the same category as gold as a core solution to a sovereign debt crisis, You know that Bitcoin has transcended the category of risky speculation. It is becoming an indispensable insurance policy in the global macro asset allocation playbook. Alright, we've talked macro. So let's zoom into a micro level story that was just as dramatic. A mining company called American Bitcoin, with the ticker ABTC, officially debuted on the Nasdaq this week. The reason this company grabbed everyone's attention wasn't just its name, but its strong Trump connection. Donald Trump Jr. is an advisor to the company. So, with that context, let's look at its first day of trading, which was nothing short of an all-out battle between the bulls and the bears. After the opening bell, ABTC's stock price shot up violently, at one point surging over 100%. Then, within a few hours, it took a nosedive, erasing nearly all of its gains and even closing the day slightly in the red. A performance like that looks less like a traditional IPO and more like the price chart of a meme coin. This event reflects a trend worth watching closely. The concept of political finance, or PolyFi, is now spilling over from the world of crypto meme coins into the mainstream Nasdaq market. People trading this stock probably aren't analyzing its number of mining rigs or its electricity costs. They're speculating and betting on a political narrative. On the Trump trade, the company's actual fundamentals might not justify this level of attention, but the political halo it wears gives it a massive narrative premium. Of course, the rollercoaster ride on its first day is also a stark reminder. When an investment is driven more by narrative and emotion than by fundamentals, its volatility can be absolutely insane. And the risks involved are extremely high. And for our final piece of news, let's shift our focus from the speculative world of political narratives to a more solid and perhaps more impactful long-term signal. US Bancorp, the fifth largest commercial bank in the United States, officially announced this week that it is relaunching and expanding its cryptocurrency custody services. This news, in my view, carries a lot of weight. First, consider who is making this move. This isn't some edgy fintech startup. It's one of the oldest, most conservative giants in the American banking system. When an institution of this caliber, representing old money, decides to offer custody for Bitcoin and Ethereum, it sends a powerful signal. It means that crypto as a legitimate and investable asset class has gained acceptance at the very core of the mainstream financial world. Second, note the word relaunch. They had a similar service before, but paused it after the FTX collapse and the brutal bear market of 2022. The decision to make a high-profile return at this specific moment shows that they are seeing real, irreversible demand from their institutional clients. The fund managers who control hundreds of billions are knocking on their door, saying, "We need a safe, regulated way to hold Bitcoin." So this isn't just a bank launching a new product. It's a bellwether for the entire industry. After a period of chaotic Wild West growth, the crypto world is entering a new phase of professionalization and regulation. The infrastructure that will onboard the next $1 trillion won't be obscure offshore exchanges. It will be the trusted, heavily regulated traditional financial giants like U.S. Bank, who have decades of brand reputation to uphold. Alright, that's all for today's Web3 Daily. If you found this helpful, be sure to hit that like button to show your support. Every day, we sift through the noise to bring you the most critical insights from the Web3 world, the information that's closest to the money, hoping that our analysis helps you make smarter, more informed decisions on your investment journey. Also, I've dropped exclusive sign-up links for major exchanges in the description below. These come with special kickback rewards that we've negotiated for our community, designed to help you save on costs as you invest.
Let's all stay rational, move forward steadily, and build our wealth together in the Web3 space. I wish all of you steady growth in your crypto portfolios. See you all tomorrow.